Good afternoon, everybody. My name is Michael Sistrunk, and today I'm going to be presenting to you a project on how to project interest rates for one-year treasuries. I received all the information from the Wall Street Journal from the dates November 4th through November 8th. And first off, I'm going to give you an overview of what happened during the week. Overall, the yield curve seems to steepen all across the board from short term all the way through long term. And this is also going to cause interest rates to rise. This is due to the fact that the Fed is going to begin tapering soon, and also that unemployment rates are decreasing, which is signs of the economy is growing. This is a graph showing the difference between Monday and Friday. As you can see, Friday it increases all the way across, and since the yield curve is increasing, this is also going to cause interest rates to increase. This graph shows the interest rate forecast for Monday and also Friday, and as you can see, it also went up corresponding from what happened to the yield curve. And now I'm going to take you by what happens each day to the yield curve and interest rates. From Monday to Tuesday, the yield curve steepens except at year 10. The interest rates also all rise throughout it since the yield curve steepens all the way across except for year 10. And 10 years treasuries also drop 4 basis points. This is due to the fact of the delay of tapering that the Fed is saying that they're going to do, and then this causes a high demand for 10-year treasuries. This is a yield curve showing the difference between Monday and Tuesday. As you can see, it stays the same around for short term, starts to steepen up to about year 10, and then there's a major drop right here. And then it also just increases for all long term. So this is going to show an increase in interest rates all the way through bottom, and then there's going to be a decrease in year 10, then an increase all the way out throughout the rest of the years. For Wednesday, from Tuesday, U.S. Treasury announces their first new treasury in 17 years called the floating note treasury. The Federal Reserve also declared that they're going to keep interest rates close to zero, and then dovish views on short-term interest rates are going to cause medium-term prices to increase. So for the yield curve, it decreases for just a little bit for short term, and then it goes back up at year 10, but then decreases a little bit through medium, and then increases slightly for long term. And as you see for the interest rates for Wednesday compared to Tuesday, they decrease a little bit for short term, they increase at year 10, and then increase a little bit for medium, but then decrease, and then increase again. So it kind of moved all the way around throughout these 2 days. As for Thursday, not much really happened. The yield curve pretty much stayed the same, except for a very slight decrease, and this means that interest rates really did not change that much either. This is due to the fact that the euro was down 0.6%, causing a stronger dollar, and investors weigh heavily on the stronger dollar. Commodities also rose, and then interest rates decreased slightly due to this. And as you can see from the yield curve, it decreases very slightly throughout the whole entire week. It decreased more toward the long-term end than it did short-term end. So interest rates will also decrease slightly throughout short-term, medium-term, but then decrease more toward the long-term side. And as for the end of the week for Friday, 10 years jumped the most that they had since last July. This was a major loss for home builders and possible homeowners because at the 30-year mark it increased tremendously. And then the yield curve steepened all the way across, and interest rates were higher for short-term, long-term, and medium-term treasuries. And here's a representation for Friday and Thursday. As you can see, for Friday it increases all the way across, and increases even more as it gets to longer term compared to Thursday. So for interest rates, they're going to increase all the way across, and then they increase through medium, short term, and then as you see at long term, there's a major jump for the 30-year. And that's the reason why home builders and homeowners are affected by this, since interest rates are up higher, it's going to cost more for homes. And in conclusion, interest rates are going to be forecasted to keep on increasing due to the fact that the Federal Reserve is planning on start tapering soon because the economy is continuing to grow, especially since unemployment rates are lower than what they had been. And also the market already seems to be compensating for the future because interest rates are already increasing even though the Fed has not started tapering yet. Thank you.